What is present value, or what are some present value concepts? Well, to start with, the idea behind present value is that you have some future cash flows. That is, you're going to have some occurrence of value at a time in the future. Now, because this is in the future, you need to understand what the present value of that is, because value received in the future is going to be worth less at that time than it is now by virtue of opportunity cost of money and inflation. Okay, so with that being said, future value received does have a present value if you are able to discount that future value. That is, bring back that future value to the present value by dividing it by a discount factor. The discount factor is generally whatever money today would return if you invested it in the market. Now, there are different market rates based upon the amount of risk inherent in a situation, but just think of it as anything that you were investing in, whether it's a secure return or a potential return, will return money on that money invested. So if I invest $10, maybe over the year it returns $1 to me, right? So actually, if that's the market rate, a year from now, receiving my $10 back plus that dollar it earned, $11, that would be the present value of $10. Because, once again, you incorporate the market rate of return in there. So if you're going to receive that $11 a year from now, if you were to trade that with somebody, the present value would be $10. You've discounted it by whatever it should have earned over that year. Okay, so what we call this again is the discount rate. Now, here's the formula for that. The discount of cash flows, DCF, okay? You've got your cash flow, that's what CF stands for, cash flow during that first period, okay? And you discount it by whatever that rate of return, that interest rate you would have received, 1 plus that interest rate, and then you put whatever time period you're in. So if it's 1 period from now, so in my example, 1 year from now, okay, this is going to be, again, a single period, $11 1 year from now. But what if I received money the year after that, and the year after that, and the year after that? You want to look at what you should receive and say that continues to be 10%, and that's your discount rate, okay? For the money I received 2 years from then, whatever that cash flow is, okay, I would discount that by 1 plus my 10% interest rate, and I'd raise that to the second power, okay, that denominator to the second power, and you would discount that second cash flow there. Now, because that cash flow 2 years from now is worth even less, right? You're discounting it by 1 plus the discount rate raised to whatever that period is, the second period. And for however many periods you have the cash flow, you add those discounted rates up, and that's what brings it back to present value. Okay, so with that being said, right, what are the uses for this? Well, if you're going to compare projects, that is, you're going to put money into a project now that will return money in the future, what is the present value? You want to make sure the project is profitable, but also if you're going to compare projects, right? One might bring in money 3 years from now, or money every year for 3 years or 5 years or 7 years, and another one might just bring in money for 2 years. And how are you going to compare these? Well, you need to bring it back to present value and make that determination, okay? So that will guide many of your decisions as an organization into what type of project you are willing to invest. So these are your core present value concepts.